Let us continue our discussion on credit risk. So, after having understood the framework and the process of credit risk management, let us move on further to the process, the steps involved in credit risk management, which in fact we have covered this one, but still a recap as a revision. We understand that whatever we discussed only in that sequence only we will try to discuss further. The first step is risk identification, as we discussed. So, risk identification. This is what risk identification is. So, assessment process, that you remember the example of 1 crore deposit, 1 crore deposit, 3 years, the case study we discussed. So, the same 1 crore deposit, 1 crore loan, 5 years we have invested this fund, asset liability. So, here we discussed about various risks. There is a possibility of default of this loan. So, the defaulters, there is a possibility of on-time repayment, there is a time risk. So many risks we have discussed, the time risk, funding risk. So, if it is not renewed, there will be a funding mismatch only, funding risk, gap risk. Then the reinvestment, if the EMI is not invested properly based on the original rate of investment, the reinvestment risk, then the embedded option risk, etc. So many risks. These are all the major credit risks which we have discussed already, identified. On seeing these are all the transactions level. At the transaction level, first you identify the risk. So, risk identification is the first process. Then we discussed about what are all the steps we have discussed. This one is risk identification. That is the first step. The second step is risk measurement. Then the third is risk pricing. Then the fourth is risk monitoring and control. Then the fifth is risk mitigation. Risk mitigation. These are all the 5 steps. That is what is described in this cyclical chart. Risk identification, quantification, analysis, capital. Of course, once you identify and measure, what is required is capital allocation. That is what is stated here. So, once you measure the capital, you measure the risk. So, corresponding to that risk measurement, you allocate capital. That is capital allocation. Then the mitigation, monitoring. Then again the starting. This is a cycle. Identification, measurement, pricing, monitoring, control, mitigation, etc. So, all these are all the risk measurement process, which may be one of the questions in your examination as MCQ. What are all the process involved? The first process involved risk identification. Or some examples. So, on analysis of a credit portfolio, they found out that the probability of default is this much. So, from where, in which area it comes under, it's a risk measurement process. That probability of assessment calculation comes under the risk measurement process. Then you identified that this is the gap risk has been analyzed. So, which comes under identification. Then pricing, the pricing has been a risk factor, the cost of risk of 0.2% is added along with the MCLR. In which area it comes under? It is coming under the pricing. Monitoring and control. Then the mitigation. So, the credit portfolio is in all the exposure has been insured, or the credit derivatives, we have covered it by forward contracts, etc., comes under the mitigation. So, such questions may come. You can expect such questions. These are all the areas of risk, credit risk management process. These are all the process of credit risk management. This process 1, 2, 3, 4, 5. These are all the 5 steps we are talking about. You remember that the 5 steps are the credit risk processes. The steps involved in credit risk management. See, now some of the major risks which already we have identified, discussed. So, we are classifying under this credit risk management, we are classifying majorly into 2 types of risk. One is the transaction point of view. All the transaction related risk are included under one head called transaction risk. Another type of major risk which is coming under credit risk are included under portfolio risk. So majorly there are two types of risk, credit risk. It is transactional and portfolio. This is the major risk which is coming up in the day-to-day business. We will come across such risk, etc. So what are all the risks? Default risk. We have been discussing about default risk. So in the MCQ, if they ask that default risk comes under which risk, of course it is a credit risk, but subcategory is transaction risk. So default risk is a transaction risk. Default risk is a credit risk. So in the multiple choice question, if there is two options, default risk is a credit risk. A, default risk comes under credit risk, transaction risk, portfolio risk, systemic risk, concentration risk, etc., etc. So default risk, the answer is, if there is an option transaction risk, you go for this one. If this is not there in your choice, you go for credit risk. Like that. So the credit risk, under credit risk, transaction risk is the major category. Under transaction risk, there are two types of risk. Default risk, which is the major risk, which is the common risk, which is a transaction risk, which is a credit risk in turn. Then the downgrade risk. So the credit quality is getting deteriorated. In that process, the grade has come down from AAA to BB like that. And the asset quality has come down. It has been downgraded. The risk is more. Those kind of risk is also a transaction risk. So downgrade risk is also a transaction risk, which is a credit risk. Remember these three things: transaction risk, under transaction risk, default and downgrade. These two are credit risk, which is a transaction risk. Now the portfolio risk. Portfolio as a whole, it is covered though, which is the portfolio is covered. The entire portfolio is taking care of some risk are there for the which will affect the portfolio. So what are all the major types of portfolio? Concentration risk. So we are doing the more and more money is kept under a single product or segment or sector. So if there is a concentration, so there is a possibility of concentration risk. If that particular sector, real estate, you are putting every money in the portfolio, real estate portfolio. If you are putting entire money in the real estate portfolio towards housing loan or construction or various things, so all the things related to real estate, you are putting money in that sector. That's a concentration. That concentration risk is a portfolio risk, which is in fact a credit risk. Systematic risk. So what is systematic risk? It affects the whole market. The entire macroeconomic condition like inflation, etc., market condition, the entire market is affected. So that kind of risk, the systematic risk. Systemic risk means the big financial institution is affected, and through which the related financial institution are getting affected through contagious risk. Those kind of risk is systemic risk. Systematic risk, what is it? The entire market is affected. All the investors, all the bankers, everything, the economy itself is getting affected. It's a systematic risk, which is also a portfolio risk. Even systemic risk is also a portfolio risk, which is in fact a credit risk. Here the entire market is getting affected. The entire financial sector is getting affected. So those kind of risk comes under the portfolio. So PR, portfolio risk, and TR, transaction risk. So CR, credit risk, mainly two types, that is portfolio risk, then transaction risk. Under portfolio risk again, concentration risk, then systemic risk, SR, systemic risk. This transaction risk again, default risk, DR, then comes the downgrade risk, downgrade. Default risk DF and DG. Here we say DF, here it is a downgrade DG. So under DR, DF and DG, remember that. So now itself you get it by hearted. So that CR, credit risk, is divided into two major groups, that is portfolio and transaction risk. Under portfolio it is concentration and systemic. Transaction risk, default and downgrade risk. So this risk you just remember, some marks you can score from this. This chart shows financial risk in credit lending. Credit risk identification. What is the first step? We have been discussing in the previous sessions also. Identification of risk. In what way? What is the process? What is the first step to manage your risk? So, the first step in the credit risk management process is credit identification. Credit risk arises from potential changes in the credit quality of a borrower. So, the risk arises from whenever there is a change in the credit quality, there comes the risk. It has majorly two components. So, we are discussing something more on this identification. In the first session, in the second or third session, we have discussed the identification through a case study, that 1 crore deposit and a 1 crore loan, 3-year deposit and 5-year loan. Through that, we know how to identify some risk through that transaction, on seeing that transaction. Here it is, we are discussing something more on that, the default risk and credit spread risk or downgrade. This is also, one is default risk, credit risk, credit risk, it is, first one is default risk, we know. Credit risk identification. The first risk is default risk, that you know very well, that default risk is the first one, default. So, credit risk. Now, credit spread risk. So, it has been transferred from one place to another. So, either it can be upward or downward. When it is upward movement from BBB to AAA, there is no problem, because there is an upgradation. There is an appreciation of asset. Here, there is a deterioration. There is a degradation. There is a credit spread risk which has downgraded the quality. That is why it is called a downgrade risk. The grading has come down from AAA to BBB or BB, whatever it is. So, there is that downgrade risk is also a credit risk. So, we have to identify depending upon the transaction or nature of movement of that particular asset. Whether it has been defaulted, that loan is committing, that borrower is committing default risk. When the asset quality is downgraded, downgrade risk. So, that is what is called identification. On seeing the nature of transaction or movement of assets or slippage, you need to identify the risk. Risk identification talks about identifying what kind of risk it is. Then only you will be able to address that risk. Unless you identify, you cannot address. You have to identify what type of risk it is. If it is default, what is the reason for that? If it is downgrade risk, what is the reason for that? Then you will find out the solution. Then you can come out with the solution, mitigation, control, monitoring, mechanisms, etc. So, all those things will address the risk. That is why identification is the first and primary part of your risk management process. Default risk and credit spread risk or downgrade risk. Default risk is driven by the potential failure of a borrower to make promised payments. We know there is no need of further explanation for that. Then what? Even if there is no default, there is still risk due to worsening in credit quality. That is why it is downgrade risk. So, there is no default, good, everything is good. The borrower is making payment, but you have the assets lying with the borrower. Whatever you have financed, he has purchased some assets. So, one example, if you downgrade, other than the downgrade of your rating, you think of the assets which are lying with the borrower. For example, you have given a loan, a cash credit of 100 lakhs. He has purchased some stocks. He has kept it in his godown. Those stocks are not moving, get obsolete. The value has come down, deteriorated. What happened in that process? Your asset to value has come down because it is your money lying there on that godown. If it is getting affected, if it is getting deteriorated, if it is becoming obsolete, non-moving, what will happen? Your value of asset is, whenever you are going and what you call the imposing penalty, what you are selling out these assets, what will happen? You are not getting the money what you have lended. You will get something. some 20%, 30% like that, because the value, the quality has come down. The deterioration of quality, degradation, downgraded. That also is an example of downgrade. Not only the rating downgrade, your value of asset is also getting downgraded. That also will lead to a credit risk. That can be identified as a credit risk. In that process, you need to address, you need to find out a solution. In what way? It has to be disposed of immediately. Whatever the money you can collect it, you dispose it off immediately, get back the money and go for another product which has a moving demand, which has a fast demand in the market. Here for this particular product, there is no demand at all. That is why it is getting obsolete and accumulated in the godown. So you go for another product and you find out the market access, what you call the research you make, and find that this product doesn't have any movement, any demand in the market. The other product which has now recently come out as fast moving demand is there. So you go for that purchase. You purchase that stock and you accumulate, you put it in your godown and sell it out. In that way, you have to give the customer a solution. You have to you advise some solution to the customer. Be a very good banker. As a banker, you need to be a good friend to the customer also. You have to give him a professional advice. So this is the position. Now you go for this one. In that way also, you can help them. You can come out of those crises also. So that is what is stated here. Even if there is no default, there is still risk due to worsening in credit quality, usually reflected through rating downgrade, which is called credit spread risk or downgrade. Rating, usually it is rating downgrade. So that is also downgrade, which is a credit risk. So default risk and downgrade risk are transaction level risk. That is what we have stated in the previous slide. So these two are the transaction risk. So risk associated with the total credit folio as a whole are termed as portfolio. The total credit folio, the entire credit folio, if it is affecting your entire credit folio, because when the market conditions are bad, during the period of recession, the entire market portfolio, our credit folio was affected. So that is a portfolio risk. The recession period, we have come across such an instance. So risk associated with the total credit folio as a whole are termed portfolio risk, which has two components. Portfolio risk has two components, what we have discussed in the slide: concentration and systematic risk. Systematic or intrinsic. It is also called intrinsic risk. Intrinsic risk. Intrinsic risk is also a systematic risk. So which may be an MCQ for your question. Oh, if the portfolio is not diversified, so diversification is a risk mitigation process which we have discussed. Diversification is a risk mitigation process. So you are putting it in a portfolio. If it is not diversified, if the portfolio is not diversified, means there is a risk. So diversification is a mitigation, risk mitigation. For an MCQ, this is choice question. Diversification is a risk mitigation technique. So if the portfolio is not diversified, that is to say that it has higher weight in respect of a borrower or geography. That is the concentration. Higher weight on a borrower or geography, sector or industry, the portfolio gets concentration. If you are concentrating on a particular, that is what we have quoted on example on real estate. If you are concentrating on such a sector, it is a concentration risk. So that is to say that it has higher weight in respect of a borrower or geography or sector or industry, the portfolio gets concentration risk. So if that particular industry or sector gets affected, if it becomes a negative impact, it will affect our portfolio, which is a portfolio risk, which in turn is a credit risk. So systemic risk is inherent to the market. This one, systematic risk is inherent to the market. So this is one of the terms which will be there in the MCQ. If there is a risk, if there is a wording called inherent to the market as a whole, that is systematic risk. So that definition which can, so this term will help you to find out the correct answer in the MCQ for systematic risk. So systematic risk is inherent to the market as a whole, reflecting the impact of economy, geographical and financial factors. Systematic risk is largely unpredictable. We cannot predict it. So that uncertainty is always there. The market movement, you cannot predict that tomorrow it will move in upward or downward, whatever it is. There is a lot of uncertainties there. So that uncertainty will affect the market as a whole, which in turn will, end up in systematic risk. So that systematic risk is largely unpredictable and generally viewed as being difficult to avoid. Of course, we cannot. We don't have any control over that. Of course, we can come out with so many, the central government imposed systems and procedures are there. So many measures are there to address that. On this bank rate movement and controlling mechanisms and all those things. But still, there is a lot of uncertainties there. So, viewed as being difficult to avoid. Financial entities and investors can somewhat mitigate the impact of systematic risk by building a diversified portfolio. This is applicable mainly for systemic risk. Diversified portfolio, this is called systematic or intrinsic risk. So, this through diversification, of course, systematic risk is not in any way, actually, somewhat to a certain extent, you can address systematic, because this is as a market as a whole, it is getting affected. But systemic risk, you take the example, the financial sector, the big financial institution and its associates are getting affected. Of course, to a certain extent, there also diversification can act as a mitigating agent, mitigating mechanism. Mitigation is one way out to come out to reduce your losses. So that is what is systematic risk is talking about. So it is inherent to the market as a whole. So one of the major risk under portfolio risk. So concentration risk and systematic risk. Concentration and systematic risk. Counterparty risk. So that is a variant of credit risk. So there are major risk is systematic risk and concentration risk. That is portfolio risk. There the default risk and downgrade risk are the transaction risk. Other than that, there is another risk called counterparty risk, which is a variant of credit risk, which arises from non-performance of the trading partner. If two parties are there, one party is not coming out with the contractual obligations properly, so he will commit default or he will commit non-obligation of he is not keeping his word, he is not paying properly or on time. So that kind of risk, done by arising from the counterparty is called counterparty risk. It is a variant of credit risk which arises from non-performance of the trading partner. As far as bank is concerned, bank is giving loan to a customer. Of course, what is the counterparty risk there? To understand easily, that is the best example. Understand easily, that is the best example means you imagine that a bank is giving a loan to the borrower. The borrower is not. Who is the borrower there? He is a counterparty. If the counterparty is defaulting, there is a default risk. There is a counterparty risk. Simple. Like that, in a contract, there are two parties. One party is not committing, he is not keeping his word. That's a counterparty risk. That's a variant of credit risk. When it comes to the credit portfolio, it is a counterparty risk. So it's a variant of credit risk which arises from non-performance of the trading partner. Then country risk is also a variant of credit risk. Like counterparty, country risk, two sovereigns are involved. So there are transactions taking place which has taken place in one country and it involves another country also. Because of the restrictions or ban on something else, the other party in the other country cannot keep his word towards meeting payment on time to the settlement of funds here in India from abroad. So there comes the country risk because of the ban imposed by the other country, other sovereign, like that. So country risk, this is also a type of credit risk where non-performance by a borrower or counterparty arises because of restrictions imposed by a sovereign. Because of so many bans, recently come across what are all the instances with regard to the tax. issues from USA and India. So many instances are there, so many risks which can experience on a daily basis. That is also country risk because of the ban or some restrictions imposed by a sovereign. So whenever the sovereign word is there, the restrictions imposed, this clause is there, that risk is a counterparty, country risk, which is a variant of, which is a type of credit risk. And also counterparty risk is also coming under credit risk. So that is about the country risk and counterparty risk, the two variants of credit risk. Then there comes the, after risk identification, we have moved our next discussion in the previous sessions about the credit measurement. That we have discussed in detail. But just as a recap, as a revision, just I will just let us discuss one by one the measurement part. So measurement of credit risk consists of measurement of the risk through credit rating or scoring and be quantifying the risk. So measurement of risk through credit rating and scoring. Credit rating and scoring. And quantifying the risk through estimating expected loan losses. So that is what we discussed. There are two types of measurement techniques, measurement tools which we used in the credit risk measurement. So why the credit risk is measured? Because unless you measure the credit risk, you will not be able to find out to which extent your portfolio has that risk. What is the unexpected level, you don't know. To cover that, what we will do? We will find out the expected level, the expected loss also, and we will keep away a certain portion of profit as this one, and unexpected portion also we will keep away a certain portion of profit as reserves. So in that way, we are addressing the loss. Here, the measurement of credit risk consists of measurement of risk through credit rating or scoring. Credit rating we do. We have so many rating agencies. Domestic credit rating agencies are there. Then internal crediting, foreign credit rating agencies are there. So we have to address, we have to rate that exposure. Which exposure you will go for that rating, that we will discuss one by one when that chapter comes. So the credit rating also we do. We do credit rating for what? To measure. According to the credit rating, we assign credit risk, that is the risk weight for that particular asset. Then we calculate capital, that is the measurement. Then our scoring, we will assign some score. If the past 3 years of financial year, that business unit has been progressing step by step, 10%, 20%, 30%, like that the business is growing, so that continuous, when we do the trend analysis, it is called a trend analysis. We analyze the trend of performance that particular business unit. On seeing that trend, it is going up, the graph is moving up. Then we assign, when we give factor some score, we give some, allocate some score, and that is called scoring. According to the business performance, we allocate a scoring, and based on the scoring, we will measure the risk. Okay, the 10 score they got, that this much is the risk. 20% they got, this much is the risk. So based on the scoring as well as the credit rating, we assign some risk and we measure accordingly. Then B, what is the other technique which we follow for credit risk measurement? Quantifying the risk through estimating expected loss. We will quantify the risk. First we will see what is the score, what is the grade, risk grade. Accordingly, we will allocate the risk percentage, the risk weight. Then we will calculate capital. You remember, capital is equal to risk weighted asset into CAR. That is the first method. Second method, quantifying the risk through estimating expected loss calculation. You remember the expected loss calculation? Expected loss calculation. That is under the expected loss. Then first one is regulatory capital plus expected loss. This is the way in which we measure the risk measurement. These are all the two steps. In the examination, you remember the steps involved, the risk measurement consists of A and B. A is measurement of risk through rating or scoring. 2, quantifying the risk through, here the word is expected loss, EL, expected loss. So that you have to remember these two factors which we consider for measurement of credit risk. So, credit risk control and monitoring. Then comes after measurement, the next step is control and monitoring. Credit risk control and monitoring system are directed both at transaction level and portfolio level. That is why we have bifurcated the credit risk into two major categories at transaction level and portfolio level. Transaction level, default risk and downgrade risk. Portfolio level, that also we have discussed. It includes a comprehensive and detailed management information system. See, risk monitoring and control, this is the key word which you have to remember. So, in the examination, they may ask MIS comes under which part of your risk management process? MIS. MIS comes under control and monitoring. Risk control and monitoring. What is MIS? Management Information System. And CIS, Credit Information System. CIS comes under Credit Monitoring and Control, which is the backbone of credit risk management. So, MIS, Management Information System and Credit Information System are the backbone of credit risk management. Remember, this is also one of the MCQs. So, credit management system. So, CRM, credit risk management, the backbone, we say that MIS and CIS, Management Information System and Credit Information System are the backbone. You have to remember that. Loan review, LRM, loan review mechanism is also called credit audit. This also you have to remember. So, one word, one more question. So, all these comes under one more question. Anything can be asked. So, loan review mechanism, LRM, it is a review of process. Every 6 months, we review high value accounts. You will call for a unaudited balance sheet, interim balance sheet, and then we assess the financial performance during the 6 months. And we will see that whether this fellow will achieve the projections for the whole year, how far it has reached, what percentage he has achieved, is it progressing as per projections, like that. So, those kind of review we do, and also the payments made during the 6 months, whether this credit made in the accounts are enough to cover the transactions taken place, the withdrawals done through the account, whether the transaction is sufficient to cover the debit transactions which has taken place in the CC account. These kind of reviews we do, that's called a review. And also the the execution of document, is properly executed. These are all covered by credit audit. This credit audit is a LRM. So, in the MCQs, another choice. Credit audit comes under LRM. LRM comes under monitoring, control and monitoring. Under control and monitoring, other than this MIS, Management Information System, and CIS, LRM is also one of the major steps involved in risk management and control, credit risk control and monitoring portfolio. So, LRM is also called credit audit. It is an effective tool for constantly evaluating the quality of loan book. Loan book is evaluated continuously, LRM, review mechanism, and to bring about qualitative improvements in credit administration. So, it will suggest, the auditor will come and suggest. So, these documents are not properly executed, you have to correct it. The transactions are not in relation with, in tandem with the business recorded in their books of account, you have to correct it. So, all those things, interest is not paid properly, you have to go for. So, there is a chance of probability based on this historical background. So, those kind of, all those things will be mentioned by the credit auditor. It has to be taken care of, which is a part of loan review mechanism, LRM. So, this is very, very important. LRM, MIS, CIS. So, credit risk mitigation, the last process. So, one is identification, second measurement, control and monitoring, then comes the review, mitigation process. This refers to the process through which credit risk is reduced or it is transferred to another party. Mitigation. Mitigation means what? Reduction. Mitigation is nothing but reduction. Mitigation is reduction of what? Reduction of your risk. So, whatever the risk you have identified, you have reduced. So, credit risk mitigation is the last step of credit risk, what? Credit risk management process, which you have to be Under loan review mechanism, mitigation. This refers to the process through which credit risk is reduced or it is transferred. See, transfer of risk. What is the example of transfer of risk? That is the transfer of risk comes under mitigation. So transfer to another counterparty. What do you understand from transferring of risk to another counterparty? So that is the best example is insurance. So insurance, the risk is transferred to another counterparty, which is the insurance company. So we are getting, our asset is getting insured. We are transferring the risk. If something goes wrong, we can get it back from the insurance company. So that is the best way of mitigating the risk. The best example is transferring the risk. This refers to the process through which credit risk is reduced or it is transferred to another counterparty. So with this, we have completed all the 5 steps of risk management in detail. Now we will move detail in the next session about the risk assignment, the risk weight assignment to various sectors and calculation, and then some discussions on the haircut. What is the haircut applied in the credit risk management? We apply some haircut or margin. What is the percentage? Then how do you arrive at your net exposure like that for the purpose of calculation of expected loss? How do you arrive at your PD, your EAD? So when you arrive at your EAD, how do you go for your finding out the net exposure? What is the applicable haircut? What are all the applicable risk weight, etc.? Next session we will continue with that.